The FASB issued an accounting standard update in March of 2017, which shortens the amortization period for certain callable debt securities held at a premium. The ASU addresses constituents' concerns that early repayment could not be considered under U.S. GAAP, even though the holder was certain that the call would be exercised. Financial statement users were supportive of this amendment because it aligns the amortization period of premiums and discounts to expectations that are incorporated in the pricing of the security. Hi, my name is Danielle Imperial in the Department of Professional Practice, and I'm joined by Jude Fernandez, and we're going to spend a few minutes going through the guidance in the new ASU 2017-08. Before we get into some of the nuances in the standard, Jude, can you walk us through what the scope of the guidance is?
Absolutely, Danielle. This ASU is applicable to companies that hold certain non-contingently callable debt securities whose amortized cost basis is at a premium to the amount repayable by the issuer at the earliest call date. The ASU does not change the discount amortization period for purchased debt securities, where the discount will continue to be amortized to the contractual maturity date. The board did state that the ASU would be difficult to operationalize if the scope included debt securities with call features in which the call date or the call price were not known in advance. So think of instruments with prepayment features if the prepayment date, for example, is not preset. Therefore, the board did decide that the ASU should apply to only debt securities that have explicit non-contingent call features that specify fixed prices and preset call dates. The ASU does apply to all sorts of premiums on debt securities, regardless of how those premiums were generated. So think purchase premiums, deferred acquisition costs, and so on. Investment companies will be required to apply the guidance within the ASU, although they are not required to apply other aspects of the guidance on non-refundable fees and costs. With that, Danielle, could you walk us through the additional details of the standard?
Sure, thanks, Jude. So the ASU requires that the premiums be amortized to the first call date rather than the contractual maturity date as required under U.S. GAAP. However, if the debt security is not called on the first call date, an entity would have to do two things. First, it would reset the effective yield using the payment terms of the debt security. And secondly, it would consider whether the amortized cost is greater than the amount repayable by the issuer at the next call date. Any excess would be required to be amortized to the next call date. As Jude has noted, the ASU does not change the accounting for any discounts. The discounts will continue to be amortized to the maturity date. As you listen to this overview, you may be thinking to yourself, well, what is the practical impact or the income statement impact of the standard compared to current U.S. GAAP? The shorter amortization period means that interest income will generally be lower in periods before the earliest call date and higher thereafter. Additionally, because the premium will be amortized to the earliest call date, the holder will not recognize a loss in earnings for the unamortized when the call is exercised.
Danielle, one quick item I'd like to point out. A callable debt security could be the hedged item in a fair value hedging relationship, but the board did clarify that entities should continue to follow their existing accounting policies for the amortization of those hedge accounting basis adjustments upon the adoption of the ASU. If the hedge relationship is discontinued, any remaining basis adjustment is amortized in accordance with the ASU.
Thanks, Jude. I think that's a good clarification to note. In terms of the effective date, the guidance is applicable for public business entities in annual and interim periods beginning after December 15th, 2018. All other entities will have an additional year to apply the guidance for annual periods and an additional 2 years for interim periods. The board did permit early adoption, including adoption in an interim period. However, if the guidance is early adopted in an interim period, it would have to record the cumulative effect adjustment as of the beginning of that fiscal year of adoption. The transition approach of the new ASU is modified retrospective basis, with a cumulative effective adjustment to retained earnings as of the beginning of the period of adoption. Additionally, in the period of adoption, a company would need to disclose the change in accounting principles. I hope you enjoyed today's podcast. Thank you for joining.